Welcome to this week's episode of What's at Stake. We're your hosts, Bryan, DeAngelis, a partner here at Penta.
And I'm Ylan, a managing director at Penta.
And we're joined today by a special guest, Neil Irwin, chief economics correspondent at Axios. Neil, you've been following the Federal Reserve closely for years, and there's certainly a lot to talk about. Welcome to the podcast.
Thanks for having me.
It's great to have you. It's a perfect time to have you. We seem to be at an inflection point for the economy, as evidenced by the fact that the Federal Reserve cut its benchmark interest rate by 0.5 percentage point last week. This is the first cut we've seen in 4 years, and there was some debate leading up to it. Would they do a quarter? Would they do a half? And it's certainly made a lot of news since then. So it does feel like the Fed is shifting from fighting inflation to addressing concerns about the slowing job market and economic momentum. But Neil, you covered this a lot closer. How do you interpret this move?
I think you're exactly right. For the last 3 years, the story has been inflation took off in 21 and 22. The Fed belatedly but aggressively, raised interest rates starting in early 22 to try and combat that. And we've been living in that world ever since. We've been living in a 5.5% interest rate environment, which, isn't as high as it was back in the 80s and 90s, but it's still, by modern standards, a very high rate. And we've been dealing with the consequences of that, whether that's frozen up housing market, the stock market drop that happened in 22, a lot of layoffs in the tech sector, bank failures back in spring of 23 that almost caused broader problems. Now we're in a different moment, and that, I think this past week has been a real juncture in that transition. And as you say, inflation's been coming down. We're not quite to the 2% Fed target, but we're well on our way there. We're about there, and the job market really is showing some kind of warning yellow signs of faltering. And we can talk about more about those if you like. But we're not in a crisis moment for the job market, but the Fed's trying to get ahead of that risk. They have to look around the bend, and around the bend, inflation really isn't that big a risk. The job market is.
Neil, you said that the Fed moved aggressively, but perhaps belatedly in raising interest rates. I think a lot of folks were surprised, again, as Bryan mentioned, by the size of the Fed's rate cut. And that kind of begs the question, did the Fed move aggressively but belatedly to make that first cut? Could it have gone at a more perhaps steady pace if it had started a little bit earlier?
I think Jay Powell, the chairman of the Fed, basically acknowledged that in this press conference. He was asked, did you make a mistake not cutting rates in July? And he acknowledged if they had had the jobs report for July a few days earlier, before that decision, it might have gone a different way. And I think that's as close as a Fed chair is going to come to admitting, we maybe ended up a little bit behind the curve because the data hadn't quite shown what we needed to see to move. It's basically in September, in this decision they just made, he got a mulligan, and doing 50 basis points is basically doing the July cut and the September cut in one fell swoop. But all the signaling was that they're not going to keep doing 50 basis points at a meeting. They're not going to keep up with this pace. They'll probably do, if you believe what Powell's saying and what's in the economic projections released, they'll probably do another quarter point at the 2 remaining meetings this year, 4 cuts of a quarter point next year. That's where their forecasts are. Now, that's the kind of forecast you get in a non-crisis, non-recessionary situation. If things stay basically okay, they can adjust interest rates on that path. If things really start to go off the rails, then they'll pull out the stops and go back to aggressive cuts.
Yeah, I'd love to double down there a little bit, because he did talk in his remarks a little bit about his concerns on unemployment, as you mentioned, and whether it's the Saham rule or others, there's been kind of flashing warning signs that, the soft landing may have a little bit of a bump, and we may be looking at some minor recession or something. It looks like they're going to keep up cuts to try to stay ahead of that. But what are you expecting, especially with the election and some other things that could, maybe not crisis, but really knock the economy around a little bit?
Yeah, look, the labor market, it's a tricky thing to describe and how to calibrate your level of alarm about what's going on. I think, frankly, I'm a little more worried about it, about the state of the labor market than the Fed is, if you take at face value the things they say in speeches and on the record, I think this half-point cut is a sign that behind the scenes they might be a little more alarmed than they let on. But anyway, so what are we talking about here? All right, the unemployment rate, recent low was 3.4% back in the spring of 23. At the start of the year was 3.7. We're now at 4.2. Now that's not a crisis. 4.2 is a great number. That's a low unemployment rate by most historical standards. But that move is not the kind of thing you want to see. And historically, you referenced the Somme rule. All the Somme rule really is, you can do the arithmetic however you like. It's the observation that when the unemployment rate starts rising and moves by half a point upward, it usually keeps going. You're usually in a recession. We're about to be. That's based on the 11 business cycles we've had since we had modern employment data. That's not a huge sample. Things can be out of sample. Things can be that doesn't necessarily apply this time, but it's a thing to watch. What's happening beneath the surface of the job market, the JOLTS, the job openings and labor turnover survey, the hiring rate has come down a lot, and it's now about half a point below where it was in 2019, which I think we can all acknowledge was a pretty good job market. The openings rates come way down. We're going to be at the point on the beverage curve. This is the relationship between job openings and the unemployment rate, where I actually asked Jay Powell about this yesterday. Are we at the kink in that curve? Meaning, until now, companies have reduced job openings but not laid people off. Can that go any further, or now to get further job openings cut, or basically, are we headed toward more layoffs and higher unemployment? So these are all things that are not sure things, and we're not in a recession now, and we're not in a crisis now. But if things do deteriorate further, we've seen the writing on the wall of where they could be heading.
And you see that too reflected not just in the macro data that you referenced, Neil, but also in some of the more micro or anecdotal data. The Business Roundtable survey that came out recently showed that CEOs are sort of cooling their plans to hire employees, and that's been a trend that they've been reporting for a little while now. And so, to your point, companies are maybe uncertain that the demand that they've seen in the post-pandemic world that we've gotten used to is really going to be there and really be sustained. And so they're tempering their hiring plans as a result.
Yeah, I've picked up the same anecdotal stuff, not just from surveys like the Business Roundtable, but talking to people who are involved in helping young people find jobs, recent graduates or current undergraduates, that the market for people coming out of college is just way tougher than it was even 1 year ago in terms of finding that first job. Again, none of this is not 2009, right? This is not the kind of recessionary, really glum job market that we've had at times in our lifetimes. But it is, it is something that the Fed and they probably need to be paying attention to, and whoever wins the election in November will be inheriting one way or another.
Neil, kind of a follow-up there. I'm just curious, both maybe from a media perspective, but even policymakers. I mean, 2009 is just the reference point for most people. That's what they've lived their professional career through. Do you see overreaction and hype even around some of these questions, because that's the only thing they have to connect back to?
So yes, I mean, there's a thing I say sometimes to my colleagues who are newer to writing about this stuff. First of all, not every bad thing that happens in the economy causes a recession. Right. And second, not every recession is as bad as 2009, right? Because the last two recessions were uniquely horrible, 2008 crisis and then the 2020 pandemic, those initial few months. Those are not normal recessions. 2001 is a more normal recession. 1991 is a more normal recession. Those were bad. Yeah, Ylan and I lived through 01. In the media business, no less, which was not a great place to be. And, it's not like it's fun, but it's not the same as there are no jobs out there anywhere. You get to 8, 9, 10% unemployment. So the question is, well, again, this is not necessarily going to be a recession. I'm not predicting that. But if we do get up to 5, 5.5, 6% unemployment, that would be a very negative outcome for millions of people. Not what we want to see, but not as bad as 08 or 20.
Yeah.
No, I'm just going to say though, Bryan, we just all dated ourselves really badly.
I was going to say.
Yeah, because the other component is, Neil, you talk about discussing the job environment in the labor market with, with people who are coming out of college or looking for their first job, or maybe even that just that second job. The financial crisis for them is a distant memory. They were still in school at the time. And so, the volatilities around COVID, and then now, seeing this dramatic bounce back, but now this softening that they're maybe not really sure where it's going to go. And that feels unsettling, I think, to a lot of workers.
It does. And, one thing to keep in mind, look, the labor market of 2021 and 22 was not normal. It was the Great Resignation. Remember workers were uniquely empowered in ways that, had some benefits. There's no question. There are people who hadn't had a raise for a long time who suddenly either switched jobs, got a better job, got rid of a bad boss, got a raise. Companies stepped up their benefits, stepped up their pay packages. Even in the organized labor sphere, auto workers, the UPS workers got very good deals. So it's not like there were no benefits to the 21-22 super hot job market, but it also coincided and contributed to that inflation that nobody enjoyed. Can we find that happy medium and just have a nice, 4% and change unemployment rate for a few years and 2% and change inflation for a few years? And just have everything get back to normal and be normal for a few years. That would be amazing. The question is, can we level out at that kind of level and have that rather than this whipsawing from one extreme to the other?
Yeah. And I think that's probably the same on rates as well. We're probably not going back to a world, because we were going through a pretty unprecedented crisis where it's, a 2% rate. He's probably aiming back towards, I don't know, 3.5 or so. Like, they'll be steady, but we were in a pretty extreme time coming out of COVID where those, if you've got your house at 2.5%, consider yourself lucky. I think we'll end up in more of a balance next year.
Yeah, and I think that, the conventional wisdom, both within the Federal Reserve, among outside economists, is that the ZIRP era, the zero interest rate lower bound era, is over for good. That this period, from 2000, basically December 2008 to early 22, the federal funds target rate was under 2.5% that entire time period. If you look at the Fed projections that just came out, the long-term Fed funds rate that the consensus is on that committee is 2.9%. So they're now expecting, even once we get through this rate cut cycle, the long-run target rate of their policy rate is basically 3%. Substantially higher than it ever was for that 15-year period. So 14-year period. So that's a sign of, again, nobody knows for sure what the future will hold, but the smart people on this stuff really suspect that we're just not going back to very cheap money.
Okay, so I feel like we've been talking a lot about the potential for recession and the weakness in the economy, but the whole point of cutting rates is to add a little more fuel to the fire. So, Neil, what are some ways that the Fed's interest rate cut might impact households, consumers? What are some of the bright sides for them as they think about this new era that we're in?
Well, some of them we're already seeing. Bond markets move in advance of what the Fed's going to do. And so over the last few months, as the data has been coming in ways that support rate cuts, bond markets, long-term yields have fallen, so have mortgage rates. Mortgage rates now more like 6%. They were up around 8% not that long ago. And we've seen that just this past week. We got some housing starts number that showed a sharp surge in housing starts and permits in August. That's good news. We just got existing home sales today, same thing. So we're already getting the housing market that's been kind of limping along with this high rate environment, lock-in effects from earlier mortgages, is showing some new life. And so that's a potential source of growth and might help keep us out of a downturn. Similar with financial markets, right? The stock market, as of the moment we're recording this, was hitting a new high. That's been fueled by this rate cut expectation as well. That creates a lot of benefits. That creates wealth effects that makes people feel richer, at least those who do have stock investments. It makes the cost of capital for companies lower. It makes it easier for companies that are rolling over debt to do that and not have onerous terms. And then just the mechanics of, if you have variable rate debt, if you have credit card loans, if you have any kind of variable rate loan, if you're thinking about buying a car, you have a more favorable opportunity to do it. The question is, have they moved quickly enough, early enough to allow all of those things to kind of kick in time to stop any kind of further deterioration in the labor market?
Do you know, I got an email on the day that the Fed announced its rate cut from the mortgage broker, Neil, that we used when we were buying our first places, saying, in case you missed it, the Fed has cut rates. Now's a great time to look at refinancing your mortgage or taking out a new one. And I thought, wow, this guy's really on it.
Yeah, that's an industry that's, they've last 2 years, there's been no refi activity because why would you ever refi? And anybody with a half decent house has just held on to it and enjoyed their 2-3% mortgage. The degree that people are starting to get feeling a little cramped and want to upgrade, and now the rate's 6% instead of 8%. Maybe you start to see some more fluidity in that market. It might grease the wheels a little bit of housing.
Neil, to that point, I hope you don't mind. I do want to pivot a little bit towards the election. We're getting close. How much does this start to sink in for the average consumer, the average voter, where we're recording this at a time where Biden's doing a victory lap right now on this rate cut? Is it enough that it'll start to be felt through the economy where people might feel a little bit better about Harris going into the polls?
I think at the margin, certainly. I've become a believer. There's been this question that I've been writing these stories, as have all the other economics writers, for the last 3 years. Look, the the job market looks good. People are seeing raises. Inflation's maybe high, but not that high. Why are people so miserable about the economy? Why are all the sentiment and confidence indicators down, in the dumps? There's an interesting paper working paper that came out a couple months ago, saying, it's easy to explain if you think of interest rates as another price, as another cost, right? So, interest rates don't really flow into the consumer price index or the inflation numbers that we normally use. But if you think about it a little differently, that if you're trying to buy a house, you're trying to buy a car, a higher interest rate does make it more expensive. That high interest rates do help explain that sentiment mystery that maybe isn't such a mystery. If you believe that story, and I do, then some relief on rates should help with people's sentiment and confidence. Is it enough? Is it early enough? Is it soon? How long does that take to play out? Is a half point? They did 525 basis points of hikes starting in 22, and now they've done 50 basis points of cuts. How does that all net out? I don't know, but I think directionally, I think it's a positive if you're the incumbent.
And I have to ask. I mean, I know Powell's answer, and I know he doesn't think about politics, but he has eyes and ears. Do you think they waited this long to try to stay, as far away? The impact to be as far away from the election as opposed to 2 cuts kind of leading up to conventions and everything else? Or is he truly got blinders on for this?
I mean, I think as Powell keeps saying every time he's asked this question, it's hard enough to try and make the right decision for the economy given all the myriad issues going on, and to try and include some aspect of political timing would just be impossible. You can't really do it. You ask the question, okay, so even if he was trying to get one candidate elected or favor one party, what would he do differently? It's not even obvious what that answer would be, right? Do you start rate cuts earlier so people get more benefit, or do you wait till right before the election so you get more of a headline effect? Do you, do you front load? Do you back load? Do you, ultimately they just have to make what they think is the right decision. And, I think there's a decent case they should have cut in July. And again, it was kind of a mulligan by doing 50 basis points here. To argue they should have waited until November just for the sake of getting after the election, it's hard to justify that. And I will say on the optics, there are 2 governors on the 7-member Fed Board of Governors appointed by Trump currently. One of them did dissent. So Mickey Bowman, a community banking focused governor, she dissented, first one by a Fed governor since 2005. She wanted to only cut 25 basis points, not 50. But the other Trump appointee, Chris Waller, did go along with this decision. I think that does help it look a little less political than it would otherwise.
That's a good point.
Do you think that, at this point, for former President Trump called the Fed's rate cut, I think, an unusual number, referring to the 50 basis points versus 25. I don't know that there's anything that Jay Powell can do at this point to keep his seat if Trump does get reelected.
Oh, I don't. That's true. Like I see very little reason to think Jay Powell would ever get another term, because if you're Trump, you've made your views of Powell very well known. Even if you're Kamala Harris, Powell, you want a Democrat in that job, and it was, kind of a borderline decision whether it was going to be Jay Powell or Lael Brainerd, appointed by Biden this time 3 years ago. Went with the incumbent, went with Powell. If Kamala Harris wins, she's going to want, if it's not either Brainerd or another Democrat in that job. And Powell's, I think he's 72, 71. He has young grandkids. He's a wealthy man. He might want to enjoy his retirement. So I don't think he's going to be angling for that job. And even if he did, I don't think he's going to get it for another term.
He's got Grateful Dead concerts to go to.
Yeah.
He can easily fill his days. He's not Fed chair, right?
Yeah, and he did an economic club event with David Rubenstein a couple months ago, and he was asked. David always asks kind of unusual questions about life, and David said, "Do you like going to restaurants?" And Jay Powell saying, "I don't really go to restaurants anymore. It's I'd rather just have people come up to you and want to talk to you." I don't think he likes the fame aspect of this job. Reading between the lines.
Not to get ahead of anything Jay Powell was going to do, but we were at the Pissarro Center's financial markets conference this week, and I was surprised to hear McHenry say that Powell might go down as one of the greatest Fed chairs if this, especially if the soft landing in the next few months work out the way he's planned. I'm curious. I know you're a journalist, but if that's more of a consensus you're hearing from folks, or even if you want to share your own opinion.
I think it's absolutely plausible, but I think a lot depends on this next year or two. He's in office until May of 2026, so he's in office for really the better part of another 2 years and year and a half, let's call it. And there's a lot that can happen in that next year and a half. And I've been thinking about Alan Greenspan a lot lately, as we saw with him. If a giant crisis happens right after you leave office and you're a Fed chair, it does not help your historical legacy and reputation. So it's not only that we don't know what's going to happen over the next 18 months or so while he's still in office, it's that there's time to tell on how much his legacy of really being the most aggressive full employment Fed chair we've had. The going back to what they did in the both the pre-pandemic era and then during the pandemic, really trying to do everything that he could to encourage a labor market recovery. That made them a little late on inflation. That's going to be the knock on his legacy. But if they can stick this landing and we avoid a recession, and that certainly reflects well on him.
Let me ask you one final question. I would love to almost pick your brain, like looking towards the future, any economic trends that you're thinking about. We're doing a lot here, obviously, around AI, and I continue to think, how will AI, impact how we think about jobs numbers and even how we connect that to the economy going forward. But what are you looking out at a couple of years?
Yeah, that's certainly one of the mega trends. I mean, the question I've been asking for months, a couple of years even, is how much of the productivity surge we've seen over the last 18 months or so is real? Is it durable? Mm-hmm. Is AI part of it, or will AI be part of it in the future? We had this period, call it secular stagnation, call it whatever you want. The 2010s were this period where low growth, low inflation, low productivity growth, elevated unemployment. And, we're now in a different world. We seem to have higher structural interest rates, possibly higher structural inflation. We have these very large deficits that are creating an upward tug on rates. And higher productivity would be one way out of this dilemma, and it would really help all the numbers if we can achieve it. So and AI would certainly be part of that. I do think, related to what I just said, the public debt is an issue in a way that the political debate does not really capture, and the next president will be constrained by deficits and debt in ways that they just have had free lunches for the last 15 years, and maybe that is not evident today, but at some point it will be. And the old Herbert Stein line is, something can't go on forever, it won't. And running deficits this large share of GDP, about 6% of GDP, much larger than trend growth, indefinitely is going to come to a head eventually, whether it's in this next presidential administration or the one after that.
Yeah, unfortunately, I'm not sure we have the time to unpack that. It was striking to me a few months ago when Powell did his 60 Minutes interview, and how careful they are with what they talk about, but he was very kind of poignant on raising the alarms about the debt and deficit and what he's thinking about there. So, well, that's great. We'll have to have you back on to dig into that one. But Neil, thanks so much for joining Ylan and I today and helping break down this supersized cut, as I think you called it in your newsletter. We really appreciate it.
Thanks, guys.
And to all our listeners, remember to like and subscribe wherever you listen to your podcasts. You can follow us on X at PentaGRP or on LinkedIn at Pentagroup. I'm your host, Bryan, here with Ylan. And as always, thanks for listening to What's at Stake.